Okay, so we are starting with trading window. So by say trading window, I mean your MT4 app. MT4 is MetaTrader 4. That's the app you use to place your trades. And we have MT4, which is MetaTrader 4 on your phone, and you can use it on your computer. So also you can use it on your tablet, any device actually. So that's what the trading window really is. Excuse me. So let's get to it. Okay, next slide. If you look at my picture here, this thing here, if you download that MT4 on your phone, this is how it will look like. MetaTrader 4. If you download it on your phone, this is how it will look like. You will see all these things that say balance, equity, free margin, margin level, percent, and margin. So we want to talk about this in today's class. So balance. What really is balance? This guy here. So what is balance? Balance is the amount of money you actually have when you have no open positions. Okay. The number changes based on your wins and losses. So basically, balance is just the amount of money that is left in your account. Okay, it's the amount of money that's left in your account. But if you're trading, if you place a trade and your trade is reading, your balance changes based on how your trade is reading. If it's in loss, your balance will show that you're in loss. If you're in profit, your balance will show that you're in profit. Okay, so that's what the balance really is. So if you fund your account with $1 million, is going to show in your balance as $1 million, right? So the next one is equity. Equity. This number contains your balance account plus your profits and losses. So what that really means is equity is your total money. It's somewhat like balance, but it contains your balance account, what is in your balance right now, plus your profit and losses. So if let's say you're like this trade now, if you look at this GDP USD, you sold GDP USD and you're in profit of $22. So in your equity, it's going to show as 22, your balance plus that $22 as your profit is going to show there. What if you have um red, that's minus $22? That's you're losing $22. It's going to show here as um your balance minus that $22. So that would be 9,880 something. I mean 9,800 and you shall know the calculation. I don't really know much that much. So that's 10,000 minus $22. You're going to see as your equity is going to read. So your free margin, that's the next one. Free margin. Free margin is the number that represents your available money. This number represents the available money you have in your account to trade when an open position is on. Okay, so this is the amount of money is left. So this equity is the equity. I mean, this free margin is the equity. This your equity here minus the margin here. That's what you get here. So that's if you take this 10,000 $10,022 minus this margin, you're going to get this free margin. Okay, and then we have the margin level percent. Okay, this margin level percent is very important. I want you to place the focus on what I'm about to say. You see, your margin level in percent should never reach 100% or below 100%. Why? Because the broker is going to take your trade out. Yeah. So let's say you place a trade and you're in loss, you're losing some amount of money, and okay, you're losing a lot of money, and your margin level percent drops to about 100%. The broker is going to automatically close your highest loss in that trade. That's how they run. That's how they do it. They're going to close your highest loss. So let's say you're losing minus 22, you're losing minus 5, or you're losing minus 6 at the same time. So the highest loss, the broker is going to close that. And why? It's because you're running at a margin call. you're running at 100%, less than 100%. You can see this guy is having 6,709% margin level. This is fantastic. So you want to have something above 100. So it says here, this is the ratio between your equity and margin. When your margin level reaches 100%, do not take on a new position, and losing trades open may be immediately closed by your broker. Like I said, broker may close out the biggest loss losing position first. All right. So the next one is the margin. I don't really understand what this margin really is, but it does not affect my loss or my profits. It does not affect how I make money. So you shouldn't bother so much about it. But margin is your down payment needed to get you in the trade. For example, if you're into real estate and you want to get a property, you go to the bank. Yeah, you cannot just go to the bank and ask for money and the bank will give you like that. You have to drop something. You have to make a down payment. So let's say the bank now says, okay, I'm going to take 20% off of, you're going to drop down 20% off of what we're giving you. So even if anything happens to property or not, they're making 20% off their own. I hope you understand that example. Basically, that's what the brokers also do. So it's also called margin call. If you're losing too much money and your account is about to blow up, like all your money is about to go, there's something called a margin call. So your broker will send you an email that says you're at a margin call. It's either you close it yourself or they close the total account themselves. Okay, so that's basically margin. Now, generally, looking at everything here, the most important is supposed to place your focus on is the margin level. Okay, you do not really need all this information to make money in the market. So I don't want you to be too confused or to be too worried that what is this guy saying. All these things are like jargons to me and the definition and blah blah blah. Okay, it's not really that important. Okay, it's not really that important to make money or to lose money in this forex market. All you just need to know is the margin level, which is the most important. Do not make it drop below 100%. And how you do that is by reducing your losses and your lot size. If you over leverage is when you risk too much money on a trade, you're definitely going to reduce your margin level. So do not do that. I will teach you how to risk a professional amount of money per trade. Okay, we're going to do that in risk management class, and that's going to be after the advanced class. Okay, so do not let this bother you so much. I just want to touch it so you know what, at least you have an idea of what you're about to go into or what you're doing. And if this information is not okay or is not sufficient enough for you, you can do your extra study. Just go to YouTube, type all these things out, you're going to get your own information. All right. So the next one. So mind you, this is the MetaTrader 4 for phone. Oh, this is not for computer. Your computer does not look like this, but this is for your phone, for your Android or your iPhone. This is how they look. So that's why I told you guys to download MetaTrader 4 and then look at how compare them to what I'm saying here. So this person plays GDP USD sell with a 1.0 lot size. I've thought about lot size, and this person is making about $22 right now. So that's 2 pips, 2 pipettes, right? If you don't understand, go back to your lot size and pips class. So the next class, let's go to the next class. So this one is more of a big deal, right? So before I go into this top order, there are two different ways you can place your trade in the forex market through your broker. The first one is the market execution. So market execution, we have market execution and we have pending order. Market execution is you want to immediately enter into the trade. All right, like now you're looking at your trade, you're seeing the market's about to buy, it's about to sell. You have your reasons why you're seeing that based on technical analysis, which I'm going to teach you in the advanced class. So you want to place your trade. So market execution is immediately you see the market is about to buy, you press your buy, or you see market is about to sell, you press your sell. All right, so that's market execution. I'm going to show you how you're going to see that on your phone. So that's market execution. you're going in immediately. So now we have the other one, which is the pending order. Pending order is for some people that are busy, you're at work, or you can't just keep monitoring your MT4, which is MetaTrader 4, mind you. So you can't keep monitoring it. So what you do is just you place an order. So your pending order is you're placing an order, price hasn't gotten there yet, right? But you have an anticipation that price is going to get there. Okay, so you place your pending order instead of market execution. Or you are busy, you're a nursing mother, or you're an employee and all that. You can use pending order to place your trades, because you might not be there when the trade is about to play out itself. So you may not be there to place the instant one, which is the market execution. So you use the pending order. Got it? All right. So the next, so we're going to talk about stop order. So in the pending order, we have two major types. You have the stop order and the limit order. So the stop order is when price crosses a threshold or a particular. This man is disturbing us in this class. So sorry about that. So stop order is when price crosses a threshold or a particular price, it picks you into current direction. All right. I know that's messing up with your head. I'm going to show you in the chat. That's why I'm opening my MetaTrader 4. But let's still get some information. I'm going to show you what I'm just talking about right now in the chat. So calm down, calm your nerves. So in the stop order, we have the sell stop. Sell stop, you place order below market price, expecting price to drop when threshold is crossed. You are entered when threshold is crossed, you will enter into the trade. So if you look at this now, so this is just a picture of what sell stop is actually about. So market has been going up and you're expecting it to sell, which means you're expecting it to drop or to fall. It's when it to come down. So what do? You enter your sell stop. So you're expecting price to, where's my cushion? You're expecting price to fall below this line, right? So you put your sell stop here at a price. I'm going to show you in the chart. Hold on, calm down. I'm going to show you in the chat, okay? I'm going to show you in the chat where to you place your price. So you're expecting price. So once this sell, those candles, I'm going to show you in the chart, those candles will be coming down, they'll be coming down, they'll be coming down. So once they pass this your price, then you are into the trade. Until they pass this price, you're going to place as your sell stop, you will not be into this trade. But me, let's say me, I enter market execution. Immediately I entered, I will have gotten into that sell around here. Right? But you would have gotten in at whatever price you set. The price could have been here, could have been here, it could have been here, wherever it is that you expect price. So when you place your sell stop, let's say imagine you place it here, you're expecting price to cross it. So until it crosses it, goes down below it, you will not be into that trade yet. Not currently in trade threshold, not crossed. Okay. So look at it here now. Now you are into that trade. You can see before it was just above it. Now it is below it. So now it's below that your price you set. Right? So now you're into the trade and you're selling with the trade right now. You're in profits. So you place order below market price, expecting price to drop. When threshold is crossed, you are entered into the trade. Now in trade threshold crossed. So now you're into the sell. The next one is the buy stop. It's just the direct opposite of sell. Okay, you know that already. So you place your buy order above market price, expecting price to rise. When threshold is crossed, you are entered into the trade. So right now you are not entered into the trade yet. But if I place my own, if I did the market execution, which means immediate entry, I will have been around this place. I'll have been into this trade here. Let's say the candle. This was where the candle is right now, and I just place market execution. Immediately I'm into the trade. But for you, you place your buy stop around here until price crosses above this your price, you will not be into the trade. So look at it here. You can see here now that price has crossed above it. Now you're into the trade. You place order above market price, expect price to rise. When threshold is crossed, you are entered into the trade. So now in a trade threshold crossed. All right, you understand that? I believe you do. So let's go to the chart now. Let's see what this is all about. What this is all about. So let's do. Okay, you can use any time frame, right? Do not ask me any question on these things, so it's not for your class yet. It's for the advanced class, so just chill. You're going to get there soon. Okay, now okay, let's use this one. Now you can see that price is falling, which means it is dropping in value, which also means it is selling. Okay, Abi? So now you expect price to sell or to fall or to drop. Now you place your sell stop. Okay, this one has happened already, so it can be confusing. Okay, let's talk about it. I'm looking for something that will not confuse you people, but we can still do it. We can still do it. Assuming live market was running today, it would have made our work easier. Okay, let's talk about it. Okay, sell. You can see that this market is dropping, is falling in value. So you want to place your sell. Now you're expecting this to happen. But you're busy, or you're not with your charts, or you'll not be monitoring your charts. You have one thing or another that you're doing. So this is what you're going to do. You place your, let's say you place your sell stop around this. Okay, let me just use my measure. So you place your sell stop around this area. If you look to my right, this place here, look to my right here. Okay, so you place your sell stop around, let's say you place your sell, because you place your sell stop, which is your pending order. Look to my right. What are you saying? What number is that? That's 1920.90. 1920.90. All right, so that's the price that you're placing your sell stop. So once market passes that line, once market passes this price, once market price passes 1920.90, you're going to be into that trade. So until market passes that price, which is 1920.90, you will not be in that trade. Okay, so the market, you're expecting it to sell, market to sell, and you want it to catch up with you and continue selling with you. That's what sell stop is, or buy stop is. It's selling and you're saying it's going to sell, so you want it to catch up with you and continue selling with you. That's what sell stop is. So we saw this and we expect it to sell based on it's another block. I'm going to teach you this. This is a sponsor kind of proportion block. So you know this is going to happen, it's going to sell. So you place, let's say you place your sell stop here, hoping that it's selling, is going to continue, catch up with you, and then continue selling with you. That's a sell stop. So buy stop, let's look for where market is buying. Okay, let's use this small buy. So expect this market to increase in value around here. We have a reason for it. Okay, I'm going to teach you the reasons why you enter this thing. It's called technical analysis. So you have a reason for market to rise, or market to go up, or market to increase in value. So you place your buy stop around here. I'll just use Control F. It's going to show. Okay, Control F. So you place your buy stop around here. So hoping that market is going to catch up with you under your price. Once it goes above your price, you are into the trade and it goes up with you. So if you look to my right, that's 1920.33. So that's the price you're going to set, 1920.33. So once price reaches that price, once market reaches that price, what I mean by market is candlesticks. Once candlesticks reaches that price and passes or goes above it, you are into the trade. You're into that buy stop. You're into that buy. So that's the work of buy stop. All right. Okay. So let's move to the next one. Okay, limit order. Limit order is like boomerang. Boomerang. Did I call that right? Price has to go one way before it goes the other way. Up before down, or down before up. Don't worry, you're going to get to it. I'm going to explain further. So sell limit. We have two types of limit order. There's the sell limit and there's the buy limit. So sell limit, you place order above market price. Price then must climb higher before it turns around and falls. Then you will be entered into the trade. I do not like how these pictures actually show sell limits. I'm going to explain that to you. Okay, I'm going to explain that to you. So we have buy limit also. You place order below market price. Price then must go lower before it turns around and rises and blah blah. So I'm going to show you because it's in the picture. It looks similar to buy stop and sell stop, so it will look confusing. I'm going to show you how. So let's go to the chart. Let me show you buy limits now. Let me show you buy limits now. So buy limit. Now this is buy limit. Let's say this market has been buying from here. Let me maximize it. Let me make it bigger. Oh, come on. Took us to the back. Okay, I can use any one. So let's go. So this market has been buying. How do you know it's buying? It's going up, right? You can see this green candle. Green candle is buy candle. Remember that. So it's going up. Let me use another. I'm not really seeing what I want in that one. So I want to use something that is very easy for you guys to understand. Okay, let's use this one. Okay, so price is going up here. It's going up. Then it sells small here. So this is what you want to do. Now price has been going up. Buy limit. You know, in buy stop, you're going to place your buy stop here. Hoping the market is going to catch up with you and continue buying with you. But in buy limit, market is buying, but you hope the market is going to retrace. Remember we talked about retrace or pullback. So you're hoping the market will retrace and come and hit your buy limit, then buy with you. Okay, let that sink in. All right, let me go back. I said buy stop. Market is buying, so you're expecting it to catch up with you and continue buying with you. That's buy stop. Buy limit. Market is buying, but you're expecting a retracement to come down first, sell first, before you now start buying with you. So buy stop is your expecting market to catch up with you and continue with you. Buy limit is you're expecting market to come back, to come and meet you where you are, and then buy with you. All right. So that's buy limit. So in this one here, you can see that market was going up. So you expect market to come back here to catch up. There's a reason. You have a reason for it. Okay, I can see a reason here. All right, this is a breaker block. So I can see a reason here. So you're expecting this market to come back. So you place your buy limit here. Then it's going to catch up with you and then buy with you. Look at this place too. Market has been buying, but you expect the market is going to. You have your reasons. The market is going to come back here. So you wait for market to come back, sell down, then now buy with you. Unlike buy stop it will continue with you, expecting to meet with you and then continue. But buy limit, expecting to come back and meet you wherever you are before you now start continuing. So buy limit get shakara. I'll say buy limit is the ladies, right? So buy limit to wait for you to come back, catch up with it before it starts continuing with you, rather than waiting for you to come and meet and go with you. So the opposite is sell limits. Let's look for an example. Okay, you see this market is selling. So market has been selling here. For your sell stop, you place your sell stop around wherever it is you want to place it. Open the market to reach it, hit it, and then continue selling with you. But for sell limits, you open the market is going to go back. Market is going to buy small. It's going to retrace. It's going to pull back. Then you place your sell limits. And place your sell limit wherever at whatever price. So let's say you place our sell limit at this price. Look to your right. You see that price? This price here, around here. Okay, look at it now. So let's say you place a sell limit around there. That's 1921.79. So that's the price you want to place your sell limit. So once price gets to that sell limit, it's going to activate your sell. Price has to touch it. Price has to get to that line. Sometimes it will cross it, sometimes it won't cross it, but it has to touch it. So until it touches it, it will not be activated. So once price touches it, it will now start selling with you. Okay, so that's the importance of selling. It's like here now, price is selling, but you have a reason that price is going to go back to retrace. Okay, we have few minutes left. Okay, so your price is going to retrace to wherever price market is going to retrace to wherever price you set, so that you place a sell limit at a particular price. Open the market is going to retrace to it or pull back to it and then continue selling with you. So it's just the direct opposite of buy limits. I mean sell limits now. So look at this picture here. You can see this is what I've been talking about all along. Buy stop, market is coming up, so you place your buy stop at a particular price, so you can see it continue with you. This one to sell stop continue with you. But buy limit, you're expecting it to come and catch up with you, pull back or retrace to catch up with you somewhere and then buy with you. And sell limit, you're waiting for it to retrace or pull back to catch up with you at a particular price also and sell with you. All right. So on your iPhone, this is how your MetaTrader 4 will be, like where you place your sell or your buy. This is how it's going to look like. So in this area that says sell limit on your MetaTrader 4, if you click on it, you see that there's market execution, there's sell limit, there's buy stop, there's sell stop. All right. So when you see this person placed a sell limit, and then at this price, look at the price, just like that price I showed you, you have to put a price on it. Okay, this price is 1.09903, and that's the price. This person placed a stop loss and the take profits. I don't think I've talked about the stop loss and take profit yet, but you can see this is how it looks like. Then you press place, and you press place. Buy limit too. This is how the Android MetaTrader 4 looks like. So if you click on this buy limit, you see a lot of other ways to place your orders. So you see market execution, sell limit, buy stop, sell stop. Also, you see that this is your lot size. We talked about lot size, right? This is your lot size here too. We talked about lot size. And then your price. Now you can place your price here too at whatever price, wherever you expect price to retrace to, or wherever you expect market to retrace to, you place that price there. Let's say 1.55419, you place it that there, or 1.00666, whatever it says, and then you place your stop loss, and then you take profit, and then you place your place, then you press your place, and then the market. If you do not put your price here, if you don't put a price, this place will not change to blue. It is white. This color is white because you didn't put your price. So once you put your price, it will change to blue, then you can place your price. All right. This one too. The reason why this place is showing blue is because the price has been typed. All right. It has been typed. That's why it's showing blue. So if there's no price, you will never be able to place your pending order. All right. So okay. So that's it for today's class. So anybody, any question from anybody? You can unmute your mic now. Any question?
Mr. Agreed.
Yeah, boss.
Yeah. These are pending order, and this pending order, the buy limit, the stop limit, the stop order, and the buy order.
Yeah.
It's a little bit confusing. You understand?
Okay.
But the buy stop and the sell stop is, at least I understand that part. But the buy limit and the sell limit is still, I'm not catching it up, so I don't know if you can just share some little light on it so that I can get it more clearer.
I believe when you watch the video, you'll be able to get it clearer. I want to believe so. But let me talk about it again. So buy limit, market is going up, right? So market has been buying. So you're expecting market to retrace first. So you're expecting market to sell down or pull back before you place your buy limit. So you place your buy. So market has happened, it has gone already. So you missed it. You missed the buy from here. So you missed the buy from here. So you're expecting market to come back, to come and take you because you missed it. And you have a reason why you expect market to come back. You can see here it has been buying. The market did what? It came back, it retraced or it pulled back. You know, after retracement or pullback. So you retrace, then you place your buy limit around here. So you'll have placed it before you even see this sell. Before you see this pullback or retracement, you'll have placed your buy limit here in the hope that market will come back to catch up with you, hit your price, and then start buying with you. So that's buy limit. Here too, market was selling, to selling, to selling. So you will not know this buy is going to happen, but you anticipated it that it's going to happen. You have a reason why you expect it to happen. So you place your buy limit around an area where you expect it to come to. It could be here, it could be here, it could be here. You place your sell limit anywhere you expect it to retrace to. And once you hit your price, it's going to start selling with you. Unlike sell stop, you're not expecting it to retrace or pull back. Sell stop, you're expecting it to catch up with you and continue selling with you. So that's the major difference. I hope you understand that.
Yeah, I understand.
So watch the video. Don't worry, when you watch the video multiple times and you practice what you're being taught, you're going to get it. Anybody else? Anybody else? If I don't get a question in 10 seconds, we're going to end today's class. Anybody else? Question, please. I'm begging.
Um, and if, for example, now,
Yeah.
if the price now refuses to trace back and to pull back, so what about what's going to happen to the buy limit or the sell limit?
If this
Like
price,
after anticipating that, yeah,
you're anticipating a sell, eh?
yeah, that is going to pull back. Yeah, that is said is going to pull back. But if the sell didn't now pull back, that is just going down, selling straight
Then you've
without.
missed it. Then you've missed it. That's it. You missed it. Bye bye.
Okay, okay,
Yes, if it doesn't
okay,
pull back, that's bye bye. So
okay. You
yes.
have to wait for another opportunity.
You wait for another opportunity.
Okay, yeah, thank you very much. I will go back. I will revisit this so much multiple times so I will
Yes.
understand it better.
Yes. Please do that. And if you have any other question, you can also send me a message on Telegram. All
Yeah,
right,
yeah,
all right.
I will.
All right, yeah. So let's end today's class. I appreciate everybody for joining. I'm going to send it to the channel. Please watch over and over again. You're going to get it. It's simple. When I started learning this thing, so it was acting difficult. But over time, when you put effort into something, you're going to get it. It's like any other skill, okay? It's not hard, and this is just the beginning. So kudos, study. You're going to get it. All right. So have a good night, everybody. Bye.
Yeah,